So just to finish off this sort of relationship between the fund manager, the assets, the vehicle, and the way the thing works. And most of you know how it works, I'm sure, but the capital is allocated. In a fund context, we'll have a fund manager who sets up a vehicle. The capital is allocated to the vehicle, not to the manager. The manager appoints an asset manager who may be his own team. The asset manager is responsible for the assets which are owned by the fund or the vehicle. So that typical setup describes a lot of the capital that's now flowing from institutions. The money's flowing into Type A and Type B. So we have a whole world of core funds out there, sometimes open-ended, usually fully occupied, income generating, low risk real estate, high quality, earning a yield of somewhere between 3.5 and 5. And then we have a second world, the Type B real estate, private equity real estate funds, usually limited life funds, 5 to 7 years, 8 years maybe, usually with a carried interest structure, often described as value add, buy, fix, sell. And it's because of the sell part of that they are limited life structures. So there's those two buckets that people tend to put money into. As a fund manager, it's pretty hard to get started in this business, and the dominance of the big players is not surprising, because the big problem with property fund management is you either need buildings or you need money to start. If you've got money to start, you've got a blind pool. If you've got buildings to start, you've got a product to sell. Young startup fund management businesses don't have money and they don't have buildings either, so what they do is they tell lies. So we go around the market telling the owners of the stock that we've got a lot of capital. We're just raising our first fund. We've had tremendous interest from all of the world's leading institutional investors, and we think we're going to raise 250 million. And we tell the capital, the 250 million, that we've got this incredible portfolio of assets that we've agreed to buy. They're definitely going to sell it to us at the price we've agreed. And then we hope that in the next 3 months we raise the capital and the buildings aren't sold to somebody else, and it all comes into our hands on the same day in 3 months' time. Rarely happens, but that's the game that we play. So if we're a seeded fund, we start with the stock and then we go looking for the capital. If we're a blind pool, we do it the other way around. Then we think about the mandates that we can earn if we're fund managers. What are the mandates out there that our investors are offering? There are separate accounts, a single client service contract, which combines the LP's capital with the GP's management resource. So I'm good at buying buildings, managing buildings, you've got money, you give me the money, I will do things with it, and I'll earn a fee for doing so, a separate account. A joint venture where you give me money, but you ask me to put some of my own money into the pot because you want skin in the game, you want to prove that I'm aligned with you. And my capital might be 2% of the 100 and yours might be 98, but it's still a joint venture because I've got skin in the game. A club, a small commingled fund, 3 to 5 investors. The investors are somewhat in control because they've decided that they want to commingle their money, and they go looking for a manager who they think they want to appoint to do something. A platform fund, an umbrella providing capital to a series of joint ventures. So I go out and raise a lot of capital. I then go looking for operators, and I say to the operator, I want you to put 2% of the money into this, and I'll put 98% of the capital in. So I'm operating a series of joint ventures. And then finally, a true fund, a pure fund, lots of LPs, one GP. The GP is in control. The GP earns the fees, and it's his business plan, his investment committee, and so on. And then if you look at a business like CBRE Global Investors, they have an interesting way of splitting their business. They have what you'd call a traditional investment management business, direct ownership, internally managed. In other words, they buy buildings and they manage them. Okay, so separate accounts, funds. There'll be a US managed fund which is diversified, open-ended, core real estate, Type A. They buy the buildings, they manage them. And you can invest in that fund as an LP. They've got Caledon Capital, which is an infrastructure investment house. And they have CBRE Clarion Securities, which is running a REIT portfolio. And then Interestingly, they have this business, CBRE Global Investment Partners. It's now got $30 billion of assets, and it does programmatic ventures, clubs, co-investments, funds and debt. So it raises capital and invests with operators, invests in funds, and it does what they call programmatic ventures. So they say, what we want to do is student housing in Spain. We found an operator. They've got one deal. We'll give them 50 million for one deal. Then we'll give them another 50 million if that works. Then we'll build a joint venture. And then we'll call it a fund. And then we'll raise more capital and sell down our interests. Diversified across the US, Europe, UK, Asia Pacific. A typical global portfolio, they have a fund called CBRE Global Alpha. It's a $7 billion US fund now, 40% US, 33% Europe, 25% Asia, diversified across residential and so on. Interestingly, there are only 22 countries in a global property fund. And you know, the vast majority of the world's countries are just not penetrated by institutional capital. That's all of South America, all of Africa, all of India, all of Central Asia. You know, when will these markets start to be penetrated? We did a job a couple of years ago for a manager based in Vienna that was trying to build a Southeastern Europe portfolio, a tremendously persuasive pitch. 7 to 8% yields, Euro accession countries, can't raise a single dollar because nobody wants to invest in Serbia, Albania, Macedonia, even Romania, Bulgaria. They're just, and yet these countries are on the edge of the euro and offering big yields. But you just can't get the capital to go. So it's a very concentrated game. What is becoming talked about a lot, though, is tokenization. And this takes us back to what you want to do. Do you want to buy buildings? Do you want to buy funds? What do you want to do? We've now got a property exchange in London called IPSX, which is offering to sell shares in single buildings. So you may not have 20 million, but you can buy a share in the mailbox in Birmingham, which looks like that, which has got Harvey Nichols and the BBC Birmingham in it. And you can buy a share in that building on IPSX for as little as £10,000. You could get a little bit more romantic and you could go to Switzerland and buy shares in a building in Zurich, and you can buy it in brickmark tokens, which are traded on the blockchain, and nobody understands what that means. But this is the world that's being hawked around now. So that's the new world. It might be Yolanda's new world, it might not be. So this idea of buying fractional interests is being pushed. So now we're up to where we need to be, and this is over to you now. So Japanese pension giant steps into real estate. They are going to put up to 5% of their $1.37 trillion into alternative assets, such as infrastructure, private equity in real estate. When you do the numbers, that's about 150 billion into those three asset classes. 1/3 in each is 50 billion in each. They've already given 5 billion to Mitsubishi to do to Japan. So that's 50 out. That's 5 out of 50. They're now going to give another 55 away to invest in Europe. So not Europe, sorry, global. So they're looking for exposure to global real estate, not Japan. The only exposure they've got to real estate is this mandate that Mitsubishi are running. They've got no team. There are no property people working for them. They've got a long-term horizon, moderate risk appetite, skeleton team. What's your strategy and your execution model? So what I'd like you to do is talk at your tables about, number one, what strategy, what countries, what sorts of assets, funds, REITs, buildings, what would you do? So if you were in control of the strategy, what would it look like? And then secondly, what's your execution model? How would you actually do it? Okay, so if you wouldn't mind just talking.
Is this a 5-year, 10-year, 20-year, in perpetuity? What's the timescale?
The mandate would probably be a 5-year mandate, renewable. But for the investor, it's a very long term.
Just to choose one, or can it be a combination?
One.
Category.
Well, I imagine they're going to build a diversified portfolio. So what would that diversified portfolio look like? And what are the categories that you'd start to think about? Okay?
So you're assuming no exit?
No exit for the Japan, no. Long-term assets. Okay, so over to you. Okay, everybody, we'll go for the answers. So we focus first on the strategy, not on the execution. So when you're thinking about the portfolio, what issues come to mind? Currency, okay. How many currencies will you be exposed to?
Well, realistically, to take your 22 countries, it'll be 21.
Okay, so are there currencies that you will avoid? Anyway, it doesn't matter. Currency is definitely going to...
Not currency.
You'll need a currency policy. You'll need to work out how many countries you're going to be exposed to and so on.
Currency volatility in relation to the expected
Yeah.
return on real estate is probably disproportionately high.
Yeah.
To the yen investors.
It's a great point. It's a very good point. More issues. At the back, yeah.
Yeah, we discussed the leverage, that we believe
Leverage.
everyone have and leverage.
Okay. Okay, fine. So that implies then you've got to go direct. Because you can't avoid leverage if you go into REITs or funds or multi-manager or... So, it's an interesting point. Okay. What else would you...
Geopolitical concern. It's obviously a Japanese government function in there, so there will be countries where they will struggle to place capital.
Risky countries like the UK, you mean, that sort of thing?
Terribly risky, or indeed where they've got some form of tension, say with China.
Okay. Okay, interesting. Yeah, absolutely. Other issues?
Well, first of all, they've got to acquire knowledge, right? They've got a very small team.
Yeah.
So the beginning of the strategy is, how do I acquire knowledge?
I think that's execution you're on now.
Okay.
But it's a really good point. Income? Do they need income? Do they not need income?
But it doesn't really matter if assets are going to be valued on the basis of income in the future. It doesn't matter whether you need it or not, because the person you sell it to
Okay.
is going to value it that way.
Okay. So there's no explicit income requirement. There will be in the long run, but they're in a build-up phase, so it's not crucial. But they will need income eventually.
I would think a bit differently on that one, on the strategy side, whether it's a income generating requirement, so do you want these buildings to produce income, to service liabilities or things like that over some time frame, or do you want to use it as a higher risk return? So how much would you want to put in core stuff,
Yeah.
basically low risk income, and how much can you put in opportunity?
Okay. So if we think buckets, Type A bucket, Type B bucket, how big is that Type B bucket going to be as a percentage?
Depends on the strategy. I mean, in my case, it really depends on what they have to do. If they need it to service their liabilities and up pension outgoings, if they don't need to do that, then they can probably put at least 50% in
Okay.
type.
Okay. Do you think the Japanese government would put 50% in Type B?
It's a very small percentage of their overall assets. So
Do you think they would do it?
If the strategy is to turn Type B into Type A, effectively buy high yielding and sell when you've created with 5 billion an institutional type asset out of a non-institutional type asset, that would be almost irrelevant.
Yep.
So long as it ends up being Type A, if you see what I mean.
Yeah, I do. It's a good point. Buildings, funds, REITs, buildings. Okay. Okay. There's a funds. Fund of funds. Okay.
Staff and in-house teams are going to be managing any project anywhere.
Okay. And geographies?
22 countries.
Okay.
I think
US North America allocation, Europe allocation, developed Asia allocation, which is going to be Australia.
It needs to be big cities, so I'd say gateway cities.
Okay, a city allocation issue. So a preference for certain
I was
cities.
thinking agricultural land, actually.
Agricultural land. Okay, we can have a bit of that.
That's infrastructure.
Okay, say
Africa.
property types we're on to now then. So agricultural, you want a bit of land. Property types. Is there anything you're going to avoid or anything that you're going to go way overweight in? Storage.
Storage.
You like to go overweight storage. Yeah.
International opens to markets.
Okay.
Geopolitics needs to be
Just underweight in anything anybody else is buying.
Like storage. Yeah.
They'll be boring. They'll have big offices like everybody else.
Well,
Big.
will-
Paris, French, 200 million job done.
How big a bet are they going to make against sectors?
They might go against retail, but
But don't they have to be just very diversified and very plain? They're Japanese, right? They're going to go across the board and they're going to spread it out.
Absolutely. Absolutely.
The key point will be capital preservation.
Yeah.
They've only got to...
The single point to start from,
Yeah.
and then it'll spread out from there.
Yeah. So diversification with capital preservation and some income, and capital preservation in real terms, looking for a 3 to 4 real return, which is your income.
0.8.
So just bear that in mind. If you're looking for that, and real estate prices rise with inflation, and you're looking for a 3 or 4 return, real, then you need a 3 or 4 income return. That's it. Job done. Sorry, I
With
had to
that
interrupt.
strategy, but with that strategy 5 years ago, they'd have bought retail, and they, capital preservation, might ask, they'd have lost half of it, in 5 years.
I got to tell you, their first deal was New York Prime Retail. That was the first deal they did. But anyway, we'll come back to that in a minute. Yeah, and
Risk is,
the appointed manager was appalled, but they'd already got the relationship. There's another issue here, and that is that these investors tend to come with relationships already, and they'll tell you what they want to do, no matter what your discretionary mandate is. Execution then. So what would your wise head tell you they would do?
So, again, being Japanese, I think they'll want to have the biggest, widest network possible because they've got a very small in-house team. So they want to have knowledge in as many of those 22 different places as possible, right?
Yep.
So I would be appointing a manager that is able then to hire other managers, but at the same time this manager can transfer the knowledge to my small team as well, so I'm still in control in a certain way,
Yeah.
even though I'm sending it to down the road.
Yeah. Incredibly wise man. Incredibly wise man. Okay, so what did they do? They didn't do that, by the way. They did that. So I said earlier that their 25 billion just went up to 30 billion. That was the clue that you were looking for. So they appointed a fund of funds manager, but a fund of funds manager in a sort of modern sense. So a fund of fund manager that does joint ventures, clubs, co-investments, and as you said, covers all of those countries, has relationships with people who are operators. As Yolanda said in her interview, you need to have access to operators who know how to squeeze income out of these assets. So that's their sell, that they are going to find these people. And they're not all CBRE GI people. They are independent operating platforms doing the best job they can in Madrid retirement, Denmark student housing, whatever. Whether that is a lesson for anybody, I'll leave it to you. But I hope you've at least stayed awake for the last hour and a half. And I'd like to thank Triangle and Metin for setting up this incredible event. And the team, yeah, what a great thing. And I think we all deserve a round of applause for actually taking the risk to be here together today. So thank you very much, everybody.